If you are retired or even 5 years away from retirement, what I'm about to explain could save you from one of the most shocking financial surprises of 2026, because something changed, not the law, the enforcement. And when enforcement changes in a digital world, the impact hits fast. Picture this: you walk to your mailbox, you grab the usual stack of paper, and there it is. An official envelope from the IRS. Your name, bold lettering, formal language. You open it. Penalty notice, $10,000. Your stomach drops. Because you didn't hide money overseas. You didn't fake deductions. You didn't cheat the system. You just moved your own money. Welcome to what many retirees are now experiencing, the $10,000 surprise. Let's build this like a mental map. At the center, your retirement savings. Around it, 4 powerful forces: bank reporting, automation, pattern recognition, and intent detection. The law behind this has existed for decades. It's called a currency transaction report, a CTR. If you deposit or withdraw more than $10,000 in cash, your bank files a report. That's it. It doesn't mean you did anything wrong, it's routine. So why are people getting blindsided now? Technology. In 2026, enforcement became algorithm-driven. Think of it as a digital surveillance grid, not watching you personally, but scanning for shapes, not stories, shapes. A $16,000 cash deposit appears. The system immediately cross-checks your tax return, your reported income, your Social Security data. If it doesn't instantly see alignment, a flag goes up. Not guilt, but scrutiny, and scrutiny can escalate. Now here's what's triggering these flags. You sell your RV for $18,000 cash. Deposit it. Flag. Your daughter gives you $25,000 to help with medical expenses. Deposit it. Flag. You take a lump sum pension payout in cash form and move it. Flag. None of these are crimes, but to an algorithm, unexplained movement equals anomaly, and anomalies demand explanation. Imagine your financial life as a puzzle. If one piece doesn't fit instantly, the system pulls the entire board closer for inspection. But here's where it becomes dangerous. There's a second layer most people don't understand: structuring. This is the silent trap. Let's say you have $12,000 in cash. You know the $10,000 threshold triggers a bank report, so you think you're being careful. You deposit $7,000 today, $5,000 2 days later. No CTR filed. You feel smart. But from the IRS perspective, that deliberate split signals intent to avoid reporting, and that act alone is a federal violation, even if the money is clean, even if it's from a legal source, even if you plan to declare it. The system isn't asking, was the money legal? It's asking, did this pattern look like avoidance? Modern software is trained to detect spacing, timing, repeated under-threshold deposits. It maps behavior. It sees repetition. It sees clustering. Picture a heat map lighting up around your transactions. That's how it works. Penalties for structuring can start at $10,000 per violation. And what shocks retirees the most? Many didn't know splitting deposits was illegal. They thought they were staying under the radar. Instead, they stepped directly into it. Now breathe. This is not about fearing your bank. It's about understanding the environment. The IRS is not hunting retirees buying groceries. These systems were designed to catch large-scale tax evasion, but automation doesn't distinguish emotion. It only sees mismatches, and mismatches create questions. So let's shift from fear to control. 3 steps. Step 1, document everything. Sell a vehicle? Keep the bill of sale. Receive a large gift? Get a signed gift letter. Withdraw cash for a major purchase? Keep the contract. Paperwork turns suspicion into clarity. If a question ever arrives, you respond with documents, not panic. Step 2. Never split transactions to avoid reporting. If you need to deposit $14,000, deposit $14,000. Let the bank file the CTR. CTR filing is neutral. Avoidance is what creates legal exposure. Transparency protects you more than concealment ever could. Step 3. Make sure your tax return reflects reality clearly. If you sold property, received gifts, moved large sums, or liquidated assets, ensure it's properly documented and reported where required. A clean narrative reduces automated mismatches. Think of your tax return as the official script of your financial story. If the script matches the transactions, the algorithm moves on. If it doesn't, the spotlight stays on. Here's the bottom line. The enforcement world of 2026 is digital, automated, and permanent. The systems are fast. They cross-reference instantly. They do not rely on human intuition, but they also don't punish preparation. The retirees who face chaos are the ones operating like it's still 2008, assuming the system works the same way it always did. It doesn't. So ask yourself this: if your financial activity were scanned tomorrow by a fully digital IRS, would your paperwork explain every large movement clearly? Because the difference between calm confidence and opening a $10,000 penalty notice is often just organization, documentation, and one decision not to split a deposit. You spent decades building your retirement. Don't let misunderstanding the new enforcement environment put it at risk. In a world of automated scrutiny, clarity is protection, and preparation is peace of mind.